Is the thrill really gone? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I told you I was skeptical of the rally. We're just about an hour here until the closing bell in the U.S. Let's get check in on where markets are. Okay, sure, we're at another record for the S&P, but this conviction does not feel real. It's just hard for stocks to go down rather than a conviction for stocks to really go up. The best performing stock, though, in the S&P is for fundamental reasons. United Airlines, we saw earnings yesterday after the bell, but the next iteration of this is the CEO saying that they're not sold on the Boeing MAX 737 going forward, and that they're looking at internal plans without that plane. What that means, no one really knows. Just a quick check-in here on other asset classes. The dollar's a little higher. The BOJ was a nothing burger. The dollar gaining some strength here. And the 10-year yield trading a little heavy. Yields up. Tons of supply remain. And I mean tons of supply from Europe as well as here in the U.S. with that 2-year auction.
Yeah, interesting. You got United Airlines on the screen, one of the big individual movers of the day. But the stock of the day, and really one way or another, probably the stock of the week is going to be Netflix. The streaming service reporting earnings after the bell on the back, of course, a 40% rally since a surprise earnings beat in October. Now, while there are still some bright spots in terms of subscriber growth and ad sales, some investors are really bristling at those elevated valuations. For Wedbush analyst Alicia Reese, one of the key issues is whether Netflix can keep content spending in check. Content spending right now that's hovering at about $17 billion a year. We're going to talk to Alicia a little bit later this hour to give us a preview of what to expect after the bell. We're also keeping an eye on housing stocks. D.R. Horton down the most in almost 4 years. Purchase contracts were up in the fourth quarter, but they still fell short of Wall Street estimates, and the company suggested that maintaining any type of sales growth would likely require additional price cuts and more buyer incentives. KB Home, Pulte, Toll Brothers, and the rest of the major home building stocks down significantly here in the session. But let's start off the show with a look at the broader market and the potential for a broadening of that record rally that, as Alex alluded to, is on pause today. Let's just call it catching its breath. Evidence of widening breadth is there, Alex. And take this to chew on. Of the 10 best performing stocks in 2023, only three actually make it into the top 10 so far for 2024. And in fact, 5 of those stocks that were the best performers in 2023 are now in the red on a year-to-date basis.
Do you find that really interesting? Because it's not just going to be, you're welcome.
I spent a lot of time looking that up.
I mean, I had to think about that stat, but it's not just the big tech really leading. And I'll do you one better. This is a great chart from John Authors, and this takes a look at the percentage of the index change since the last time we hit a record high back in 2022 of January, and the points that moved, right? So basically the biggest contributors to the rally. NVIDIA, obviously we get that. That's really high on the list, as well as Microsoft. But in this list, we have some really boring, old school, old economy companies like Exxon, like Merck, like Berkshire Hathaway, Eli Lilly, Visa. These aren't the sexy high flyer AI names like NVIDIA. They're not even part of the Mag 7, and yet those guys contributed a lot to the S&P. So, Romaine, we talk about tech leadership, but you have to wonder, is breadth all that bad?
Well, that's a good question. Let's pose it to our first guest as we kick off to the close here on this Tuesday afternoon. Brian Weinstein, head of global markets over at Morgan Stanley Investment Management, joining us right now here on the close. And Brian, let's pick up where Alex left off here. A lot of questions here about the breadth in this market here. Are you finding that breadth there, or is there a little bit more to be desired?
It's a great conversation. January markets always make me nervous because everyone comes in with all this bluster. It's all going to be different. And then you end up in these periods like now where there's a lull and it looks like the old leadership's coming back. But I think you guys are onto it. I think the leadership is changing. I think it's going to take a little bit more time. It's going to take a Federal Reserve that does its job. It's going to take us getting through the malaise that came from high interest rates at the end of last year. But I think you're right. If you look at energy, if you look at some of the healthcare drug companies, AI is not only going to help the same 7 companies. If this is real, the effects of it are going to spread throughout the market. Not every stock, but there's going to be a time for this breadth to change. And I do think over the months that come, we're going to see that.
When we talk about potentially widening out of any sort of additional gains here, do you think that this will sort of be, I guess, more of a broad sector pick, meaning people can look at certain sectors and say, okay, here's maybe potentially where the money goes? Or do you think they need to be even a little bit more selective than that, really drilling down into those individual names?
You know, I do think you can get some broad-based sector rallies here. I mean, that said, Are there some smaller companies, if you can pick them out, are going to do things like the Magnificent Seven have done? I'm sure that there are some winners here that are larger than others, but my bet would be that investors can actually go to different sectors, go to some things that have lagged. I'm not sure how far down the cap structure you can go. I don't know if it goes big into small caps or mid caps. It's harder to say, but I do think from a sector basis, the leadership, you'll find individual names, but I think you'll find that your sector rotation is pretty powerful in the next couple months.
To what, Brian? Like, what's it going to rotate to? I was just really struck by the stocks that have led in the last 2 years, and it's kind of all over the map, really.
It is all over the map. It is all over the map. Listen, if fixed income yields do kind of stay low or even fall from here, I think you can look at some of the more boring utilities that pay dividends. Again, I think there's a commodity play out there. If a Federal Reserve is really going to ease 4, 5, 6 times this year, and the dollar can weaken a little bit, some of those sectors have really lagged, and there's, I think, some broader shortages and other international events going on that could help commodity sectors and energy sectors do well. And I do think there are winners inside of healthcare and pharmaceuticals that you guys had mentioned a few names where there can be leadership also. But I think tech, right? Maybe it's the Nasdaq 93, right? The rest of the tech industry. I mean, there's no reason why there can't be a continued tech rally. I don't think it's an it doesn't leave tech behind. It's part of the story.
Not anti-tech. It can be more inclusive for sure. But what we're not saying is the dreaded V word, which is value, because that has definitely been a value trap unless you've been trading it really well. With small caps, for example, can you not look at it in value versus growth terms anymore, Brian?
Yeah, it's not something that's worked terribly well, and it's not really the way as I like to describe it. So yeah, I'd stay away from that as the simple delineation, because I think growth is going to do fine if we have a broad-based rally. Investors like it; they like it for a reason. It's where the excitement is. Again, it's going to trickle through lots of other industries, but I wouldn't couch it in value versus growth as the right way to rotate out of the winners.
Is there a sense here that when we talk about the idea that so much of the rally that we had up until this point was really driven largely by rate expectations and the macro conditions tied into that, is that going to continue to be the dominant narrative for, at least for the equity market in 2024? Or do you think we'll shift to more, of those idiosyncratic stories, those bottom-up fundamental type of stories?
I think for the next couple of months, it is going to be really important what the Fed does, right? Because the expectations are so high. I think it's interesting in the last few weeks that interest rates have gone up and the equity markets have been stable to a little bit higher. So maybe we're breaking that correlation where interest rates go higher and stocks go down at the same time. Listen, the Fed wants to ease, right? The inflation rates have fallen. They want to declare some victory. They want to make conditions easier for people. So the macro, I think, will be super important as the Fed gets going. From there, I think you're right. It goes back to earnings. It goes back to more idiosyncratic stories, but I think the macro plays the first half of the year.
You think the Fed wants to ease, Brian? I mean, I know the market wants the Fed to ease, but at least publicly, all the members of the Fed seem to be suggesting, just kind of slow your roll a little bit on those rate cuts.
I think what the Fed wants is the market not to think they're trying to juice the equity market, or they're not trying to. What they're trying to do is say, listen, their rules suggest when inflation goes up, you raise rates. All else equal, when inflation falls, you should bring it back towards neutral. No one on that Fed thinks neutral is 5.5. They all think it's restrictive. So yes, I believe this Fed wants to ease. They're just trying to pick the right time to tell us because they don't want to be in charge of another bubble. They're just trying to move policy based on their really Taylor rule. And so again, I think it's 4 or 5 times this year starting in May, but they could just as easily start in March, and it will depend where inflation goes, how far they take it.
Romaine, you really want it to be bottom up, don't you?
I kind of do.
You know what? I'm waiting for that too.
That's my specialty.
So when
macro people,
when we get to have that fun day, that's going to be a moment. Hey, Brian, last question before we go here. Why do you think it's so hard for stocks to go down right now? I know that might be a silly question.
Yeah, I wonder about that all the time. I mean, listen, I think from a broad-based perspective, if you're sitting on your 5.25 money market fund and you're saying, well, I know the Fed's going to lower rates, you're trying to time it, I think money's going to start to leak out of some of these safer assets and go into equities. Everyone wants a dip. Everyone knows the Fed or wants the Fed to ease, as you said. So I just think that there's a lot of money coming out of safer assets and some fixed income assets to go into risk. And I'm afraid what's going to happen is it's going to start to happen more quickly. That's when you get your broad-based rally. That's why it's not idiosyncratic yet, because that money is going to come into sectors and indices, and then you get your idiosyncratic later. But that's why I think it's so sticky. I think people are starting to realize that 5.25 money markets aren't going to be there forever. So let's start to get money out in the market, and it's only going to continue for the next few months.
All right, well said, Brian. We'll catch up again soon, I'm sure. Brian Weinstein, head of global markets over at Morgan Stanley Investment Management, helping us kick off to the close here on this Tuesday afternoon. And I looking forward to after the bell and results out of Netflix, and a big announcement already. Netflix laying the smackdown on its rivals with a $5 billion deal to air WWE, Raw, and other wrestling programs here. A big push into live events. We'll have a full breakdown in just a second.
Plus, shares of 3M close in on one of the biggest drops since 2019. More on those disappointing results fueling that fall. Love this story. It's today's Stock of the Hour.
And a closer look at private credit. Competition for lending heating up. The Copia Group's Beata Kerr are going to be joining us with more insight on a corner of that private space that she thinks has a lot more room to run. That conversation and so much more coming up in just a bit. This is The Close on Bloomberg.
The 2024 nominating contests are here, and the candidates are making their cases to New Hampshire voters ahead of the primary.
New Hampshire is going to speak very loudly.
Bloomberg is live in the ground, bringing you the fastest news.
Trump is leading by a long shot.
Insightful interviews.
Nikki is the one that has knocked all these other candidates out of the race.
And the most informative analysis about what it all means for November's presidential election.
What is your path to the nomination?
Coverage continues today, only on Bloomberg.
The Fed has not done well in the past 3 or 4 years in terms of, or 5 years, in terms of trying to find that magic Fed funds rate that will neither increase inflation or produce deflation. And so, are they wise enough now to know exactly what the Fed funds rate should be at any point in time, or even, 6 to 12 months down the road? I'd be very cautious.
That was PIMCO co-founder there speaking with Remain and Me yesterday. He also went on to say that the Fed should stop winding down its balance sheet and start cutting rates in coming months to avoid a recession. I get that he's talking his book short, but still, nonetheless, he's not the only one. Bloomberg's Michael McKee, international economics and policy correspondent, joins us now. Mike, what did you think of what he said? Like, stop QT and cut rates all at the same time. Is that a realistic, dual tool that they're going to use?
Well, it's a debate about what they're going to do, because if you're still doing QT, even at any amount, and you're cutting rates, you're working against yourself because one tightens and one loosens. But the markets are expecting, at least as far as the Fed's concerned, a regular and predictable kind of exit. And so the feeling is they would announce some sort of taper before they actually cut it off.
What actually, I guess, would drive that? Sort of what would be the catalyst? Because right now, when you look at the communication they've made publicly and you overlay that with the data, I'm not really seeing an exit.
Well, it really depends on how things develop the next couple of months, because what they're looking at is for evidence that we're seeing inflation on a strong path to 2%. Now, where does that leave them between 2 and 3? We don't know. But Friday, we should get we will see the headline PCE number, which is their target, probably remain at 2.6%. And then we could get the core rate below 3%. And that'll set off maybe a market reaction as people start to think, well, we're getting closer and closer, and March could come back into play. I noted this today.
But does it matter? I mean, those are the year-over-year numbers. Does it matter that the month-to-month numbers are at least going to accelerate based on economist estimates?
Well, month to month is important in terms of a trend, but it also matters what is driving it. For example, in the headline number, if it's oil prices, they're going to look through that. And so it'll really be the components. And they'll be looking in the core at real estate especially. I just want to mention, I looked today and we're down to 40% chance of a move in March. Remember, it was
that
like
re-rated fast. 80 on Friday.
It was 80% a week ago. So the markets are finally getting the Fed's message.
Goldman, though, sticking to that March call there for the first cut. Okay, so that's going to happen Friday. But in between them, we got the BOJ, which I call a nothing burger, and then we get the ECB on Thursday. And I'm wondering about the pressure that the Fed is giving to these central banks to do something quickly, or they will put the pressure on.
Well, there's a little bit of pressure on the ECB, but not a huge amount, in the sense that
if the Fed goes, the ECB is going to have to.
If the Fed goes, then it means that the euro, in theory, gets more expensive, and that may not be good for the European economy, but it probably is so priced in at this point it doesn't make a big difference. Now, the Bank of Japan, they're going in the opposite direction. They have not moved their policy rate for 16 years, and they've got the yield curve control that's been going on for years and years. That they've sort of taken the cap off, but markets are still respecting it. And basically, they said today, overnight, that we're going to make these changes. We're going to make them sometime soon. Now, the debate there is when to do it, and the feeling is they might wait till April, because in March, they'll get the results of what they call the Shunto wage negotiations. It's a sort of a countrywide wage negotiations for small and medium-sized businesses. They want the opposite of what the Fed and ECB wants. They want wages to go up. The union representing the union representing the workers said we want 5%. They got 3.8% last year, and the company's representatives said we want to do at least 4%. So they're going to raise it from last year. They're going to get some more additional increase. It's just a question of how far it goes, and then the Bank of Japan will have a better idea of what it wants to do.
I'll take 3.
Yeah. All right. Michael McKee, our Bloomberg International Economics and Policy Editor. Of course, a discussion about Japan, but also a big focus here on the big economic data points we're going to get this week out of the U.S., including that first look here at GDP from the last quarter. All right. Coming up here on the big program, a preview of Netflix betting big on live events with a $5 billion deal for World Wrestling Entertainment, plus the big earnings after the bell. Alicia Reese over at Wedbush stopping by the program to give us her take on what to expect. That's coming up next on The Close. This is Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Coinbase. JP Morgan downgrading to underweight, saying the biggest U.S. cryptocurrency exchange could fall victim to a slump in the Bitcoin ETF hype. This marks the analyst's first sell equivalent rating on the stock since JP Morgan initiated coverage back in early 2021. Shares down 3% here on the day. Next up, let's take a look at Enphase Energy. The sun shining today on the solar power company with an upgrade over at Truist to buy from hold. The analyst saying that while we haven't seen the end of volatility in the residential solar sector, Enphase will be among the big winners when the Fed moves into a rate cut cycle this year. The price target bumping up all the way to 145 from 85. The shares today bumping all the way up by about 4.5%. And finally, SiriusXM. Wells Fargo turning the dial on the satellite radio company with a downgrade to underweight. The analyst says the valuation and stock price have improved since the announcement of that tie-up with Liberty Media, but not due to any better fundamentals. He sees weak subscription revenue and higher operating spend adding to the static on that channel. Shares of Sirius, which are already in the tank, moving basically unchanged here on the day, and those are some of our top calls. All right, let's turn back to the big story of the day, potentially that is after the bell. Netflix, the streaming giant, set to announce earnings after the bell tonight, but earlier this morning, they had another big announcement, a $5 billion 10-year deal with WWE. That's the Pro Wrestling Association here. Nick Khan, WWE president, had a chance to catch up with us just a while ago. Take a listen.
We're pleased with the deal, and we love the fact that Netflix was willing to take a bet on us. For us with Raw, it was yet another test of someone new in the space, obviously an established streaming entity, the streaming entity, if you will. It was a good bet by us, and we think a good bet by them.
Nick Khan there, who heads WWE. Alicia Reese, who's vice president of equity research over at Wedbush, joining us right now. She has a $5.25 price target on the stock and an outperform rating. And before we get to the earnings tonight, Alicia, let's start off with that WWE deal. As a recovering pro wrestling fan, I have to say I'm somewhat excited about this, but I'm also curious to see how Netflix is really going to deploy this. I mean, live streaming is a much different animal than what they currently do right now with this sort of library of content. How do they navigate that?
Yeah, I think it's an encouraging sign that their advertising platform is starting to really peak. It's starting to do really well. They've tested some live programming so far, and they're entering the waters with a fairly large sporting event in WWE. I think, this is a great way to test the waters and do something amazing with the existing viewership and maybe expand that viewership as well. Something similar to what they did recently with the likes of Suits, licensed content.
Yeah.
They took, an old title and just really burgeoned that with their massive viewership worldwide. So I think they could do a lot with it. And it's not just the live programming; it's also all that shoulder programming, the documentaries, and the original series that will come out of it.
Well, that's what I'm curious about here. Do you think that they would have done this deal if they were still kind of under that old model, just a pure subscription model, rather than having that ad tier?
No, I think the ad tier definitely gives them a lot more money to play with, a lot more different types of programming to play with, like sports. Live sports really do require, especially for the price tag, it requires some sort of advertising capabilities and also just the format of it. It requires breaks. And Netflix's ability to support that kind of content does, give us an encouraging sign that its ad tier is starting to really take off.
Alicia, I didn't think about that because the ad breaks. This is a great point. On the flip side, though, are we worried about content spend? Sports are expensive. I mean, they're paying twice the amount that cable was paying for WWE.
Mm-hmm. Well, I think there are two ways to look at that. One, yes, sports is expensive, but they're not betting on the NFL right now. I also think that $17 billion content spend that they had discussed before could be significantly less than it was, and that's for two reasons. One, because they are doing so well with licensed content right now, which is significantly cheaper. They don't need to spend quite as much on original produced content as they had before. Additionally, you saw just this week also that Netflix chairman of Netflix Films, Scott Stuber, also is exiting. And that, I think, is a signal that Netflix is moving on a bit from its original movies, which are very, very costly and don't bring in a ton of viewership. And when they do, it's for a couple hours. It's not necessarily rewatchable. So having more licensed content, more content like this, like WWE, is going to really get, keep the service more sticky.
Alicia, we're like a week away from Netflix already hitting a 52-week high. Is there any setup we get in earnings after the bell where the stock actually can move higher here?
Yeah, I mean, there's definitely high expectations going into the print. So I think what investors are really looking for here is, one, that the password sharing crackdown is still, obviously it's diminishing what they can still get from that, but can they still get more family memberships, which is going to drive ARM higher? Can they still get, more of those churned out or released bundlers to take their own accounts? And when they do, are they going to pick the ad platform? Mm-hmm. Our, proprietary surveys in the intra-quarter are still suggesting that there's, still money to be squeezed out of that password sharing crackdown, and a lot of those churned out, customers or released customers are coming back and paying, and more often than not opting for that ad tier.
Yeah.
The other portion is, when does the ad tier become accretive?
Right.
And the work we've done, based on all the data points, either that we've gathered or that have been publicly provided throughout the quarter. Yeah, it's really encouraging.
Yeah, Alicia, we got to leave it there. We're up against a hard break.
Sure.
Thank you so much. Thanks for checking in before the numbers. Alicia Reese, Vice President of Equity Research over at Wedbush. All right, coming up, we're going to talk about private credit giving big banks a run for their money. This is Bloomberg.
Of New York City, that beautiful skyline, 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. I told you yesterday the equity rally was boring.
Yeah, well okay, boring. I mean,
a snooze fest.
A snooze fest. I mean, it makes you wonder, though, when we talk about sort of the, I guess, pause, let's just call it that right now, that we're seeing in the rally, whether this is sort of a real reassessment of valuations or it is indeed a pause and we'll just find some other sort of upside catalyst to push stocks.
I 100% think it's going to be the latter.
Yeah.
But it is fun to have a pause, but have individual stocks have tons of fun reaction all across the board with earnings. I like that. I dig that. Okay, well, the equity rally, as we're talking about, taking a pause or petering out, you decide. One area that keeps attracting money, private credit. So deal volumes might not be as strong as 2022 and 2021. It's still a $1.6 trillion behemoth industry. Money flows in, are returns delivering? Well, GoldenTree's CIO was a little more conservative when he spoke to Bloomberg Television at Davos about how he expects credit spreads to narrow.
I'd be surprised if the next 5 years resembles anything like the last 10 years. The historical returns that you've gotten, around 300 basis points of excess return, I'm skeptical you're going to get that in the future.
Joining us now is Beata Kerr, Managing Director and Chief Impact Officer over at the Copia Group, where she focuses on direct lending to lower middle market businesses. Of course, direct lending is a big subsector space of private credit. Beata, what kind of returns would you be expecting this year?
Well, we still think private credit loans in the lower middle market. So we're focused on companies with EBITDA under 20 million. And I think it's important to point that out because the middle market has 100,000 companies in America. So you can have very big return differences depending on the size of company you're talking about. And with the type of companies that we're targeting at that size in the lower middle market, we still see return opportunity in the 11 to 13% net range, and that is unlevered. So SOFR plus 7 to 8 is really what we see as the norms. And we acknowledge the GoldenTree comments around some spread widening and a little bit of lower deal volume last year. But again, we're seeing an anomaly in the lower middle market because it's incredibly underserved as the private credit funds have become so big on average that the deal sizes are much bigger than where we're focused.
Right, and also they can compete with banks too. It's just a different kind of world. So with that in mind, Beata, how is this space different than 2 years ago in terms of the sectors or the type of lending that's happening?
Again, I think we have to differentiate between under $25 million EBITDA and then the whole middle market. I think one of the big differences is that there's incredible concentration at the top. So a recent statistic around private credit fundraising from last year shows that 70% of the new flows went to 4 firms. And actually, private credit fundraising was up year over year, which was in contrast to private equity, but the number of managers participating was down. So in terms of industry concentration, I think there's more concentration. In terms of returns, I think you're seeing more covenants on deals. The pendulum has certainly swung in favor of the lender. The borrowers that we are talking to, you're right, the banks used to be there years ago, but due to Silicon Valley Bank last year, $1 trillion of deposits left the banking system, and the banks are even more constrained. Really, the regional banks were more the traditional lenders to the smaller size companies that we're focused on. So again, we see deal volume up year over year, not down, and we see spreads remaining pretty consistent year over year as well.
But does that mean that the types of deals that you're looking at today relative to, say, I don't know, a few years, say prior to the pandemic, to draw sort of a line in the sand here, is the risk reward ratio better now than what it was then, or basically about the same?
We actually see it as better, which I think may be surprising for some, but we were just looking at the default rates in the Proskauer index. And again, here, what we're seeing in this under $25 million EBITDA range, the default rate is actually half. It's currently 0.7%, and that is half what the current default rate is for the total middle market deal environment in terms of private credit direct lending. So we're seeing better risk-adjusted deals. We're seeing stronger covenants, and we're seeing more volume.
Can you carve out a niche in this space right now, given how big this industry has gotten? But, of course, with that increase in size has come also with a huge increase in the amount of people in here chasing after the same deals.
We can carve out a niche. In fact, at the Copia Group, we're particularly focused on our theory of change is on shrinking the wealth gap. And it's around the idea that wealth is not distributed equally in America, and ethnically diverse business owners and women business owners have not had equitable access to capital. And we view private credit in many ways like a bridge loan. It's like growth equity financing that can sometimes substitute for private equity. And these business owners may not have the same network of available capital or mentorship. And so we really feel like we're filling a void with this population in particular. And so that's how we're carving out a niche in this market where we, again, don't see, dozens of players focused on this.
Beata, go macro for a sec. Say you get the Fed cutting rates, let's just ballpark it 4 or 5 times. Economy slows, but it's not like a deep, deep recession. we're able to maintain a good job market. Inflation kind of comes down. What happens to your space? Is this like ignite animal spirits here? What happens?
I think that's the perfect environment for our space. I think that's the consensus view on this kind of soft landing scenario where the economy keeps on ticking along. There's some pressures in some sectors, but as a credit underwriter at the top of the stack, you're always concerned about minimizing the macro risks, client concentration risks, and focusing on the end market and building in protections. So that soft landing scenario, which we think and consensus thinks is really most likely, is a sweet spot. Now, whether the banks return to the market will be the question. And at the moment, I think the banks, both regional and money center, are focused on more profitable initiatives, wealth management, other types of shorter term lending, but cash flow lending that's longer term, like growth capital and acquisition financing, still seems to be a space where the banks are really not front and center anymore.
All right, Beata, I'm going to have to leave it there. Great to catch up with you, and really the best of success here with the new venture. Give my best to Chandran and the rest of the team. Beata Kerr, Managing Director and Chief Impact Officer over at the private capital firm Copia Group. And Alex, we talk about this idea, too, of sort of just how big this industry has gotten. We've gone from a relatively nascent industry, 25, 30 years ago, that was really only worth probably a few $100 million. Now, of course, this is $1 trillion business and on its way potentially, as she alluded to be more if the banks continue to retrench.
I know, but then what happens if regulators want to get in on that? Because the whole point of why banks are retrenching is because they can, because new regulation.
Have you ever posed that question to one of these folks? Because they always sort of blow it off. They say, no, don't worry.
No, it's okay. We're responsible. Everything's going to be great.
But at some point, it's like you become too big, even for the regulators, and they have to do something.
Have they tested? Has it been tested in a real crisis in the same way that, the great financial crisis maybe, but has it been tested?
It has not, but there was an interesting Fed study that actually came out, I think it was sometime late last year, where they actually did go back and really stress test private capital scenarios here. And they actually found that the risk there was actually a lot less than I think what people thought. Yeah, it was an interesting study. We did a whole thing here on the close. At the time, you were knee-deep in the European close.
Right, so we did different things.
Yeah, I don't know what goes on over there.
There's a storm.
A storm?
There was a really bad storm, and some planes got grounded. No, a nuclear facility is not doing well in France. There's some stuff.
Okay, all right. A lot of stuff going on here, too, as we count you down to the close. A little more than 20 minutes until we get to those bells. We're going to have a discussion here about 3M, one of the biggest decliners here on the day. The share's in a free fall. It's our stock of the hour, the close on Bloomberg. Welcome back to the close as we count down to those bells. A closer look at the biggest mover of the day, 3M shares tanking after this forecast disappointed Wall Street. Abigail Doolittle joining us right now for our stock of the hour. Triple M here, down 11% on the day. What happened?
Yeah, it's pretty amazing. The worst day since April of 2019. And what really stands out is this degree of the decline. It's not a huge profit guide down that they made. So in terms of the quarter that was, they actually beat. But for the forecast for 2024, they took down earnings guidance by 6 cents on almost $10. So it's
6 cents.
6 cents. That's like instead of $9.75, it's something like $9.69. Sales was a little bit more, 2% growth versus 2.7 growth. But the reason that we're having this huge decline, I believe, is the fact that this company's been in a world of hurt for a while. They did a restructuring last week. The numbers started to improve last year because they laid off people and they made other changes. Everybody thought this was going to be the bottom, that numbers would stabilize, and they still came down a little bit. The CEO was talking about the idea that the end markets are still not great, but there's still weakness there. So they're getting penalized in a massive way.
I love 3M because it's an early cycle industrial and it has exposure to literally everything.
Yes.
Industrial, China, consumer electronics, etc. They also had some litigation issues, though, and I wonder if that's seen a trough.
Well, it's a great question. So last year, yes, the earplug lawsuit, they settled that for $6.6 billion or $6 billion. And then they had a clean water, or excuse me, it was forever chemicals in water. They settled that for $12.5 billion. So the removal of those lawsuits is very good. But interestingly, to pay for it, this company is a dividend-rich company. They may have to take that out of the dividend. So from the investor standpoint, you have the removal of the overhang, but you might not have the financial help out for earnings. So, yeah.
So this gets to a question now, right? When we talk about sort of whether 3M is a bellwether for, I guess, the rest of the sector, and more importantly, some sort of bellwether for the economy at large. Is that correlation there at all?
I think that it has to be. I mean, I haven't done specific work on it to know, but just in terms of what Alex was just saying, they do everything. I mean, I'm a Post-it fan. I have Post-its everywhere, all over my
This does not surprise me about you, by the way.
I know, little notes, little quotes everywhere. It's my favorite way to go. But they are in every end market, and so the idea that this CEO, who knows, maybe he's taking advantage of the weakness and trying to say that it's the end market and it's really not a cause and effect. But he very clearly said the electronic market is starting to stabilize, but the industrial, the retail, not so much. So it could be. And if you think about it from the same...
Yeah, but it raises a lot of questions, too. I'm sorry to cut you off, but just kind of about that sort of conglomerate model.
Yeah.
Because the whole idea was that when one thing is doing bad, the other stuff is supposed to help out, and I don't know if we're necessarily getting it.
Well, it's such a good point, because you have GE here, and they actually didn't have a great quarter either, but they're spinning out, they spun out healthcare, they're spinning out energy and aerospace. The age of the conglomerate might be going away. It's going to be interesting to see like if 3M does something like that.
I think it has. I mean, I think the overwhelming statement is it has, but 3M didn't do that, and it was supposed to be diversified, but that hasn't played out.
Yeah, I mean, how many of these big industrial conglomerates are really left?
3M and Honeywell.
In the true sense of that, and even Honeywell.
Even Honeywell, you could argue
of what it used to be.
100%. But still, it just shows to me too is that if you miss and your stock was already doing well, you are just going to get hammered, even if it's by 6 cents.
Yes.
So there's definitely a management expectation game that hasn't been played well.
Yeah, and this one, I think it really was the fact that analysts were saying that this was the bottom. But the bottom, clearly, from a technical perspective, it actually does look like the bottom's not so far out. But from a fundamental standpoint, they wanted numbers to stabilize, and they simply couldn't do that.
All right, Abigail, thank you. Appreciate it very much. All right, coming up, the main event right now. You got earnings from Netflix, Texas Instruments, Baker Hughes, all out after the bell, plus more on expectations this earnings season with Leo Kelly, CEO over at Verdance Capital Advisors. This is the close on Bloomberg. Headline level, markets pretty much doing a whole lot of nothing, but underneath the hood, lots of interesting stock stories that are moving. Bond market sell off a little bit, yields climbing modestly higher, particularly on the long end. The close coming up next. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. 10 minutes, Alex, until we get to those closing bells. You wanted to pause in this record rally in equities, and I guess you got it today here. The S&P only up fractionally on the day. The Russell and the Dow lower fractionally on the day.
But look underneath it, and it's actually really cool. A lot of stuff going on.
What's going on?
Underneath the hood. You got the home builders, XHB, because DI Horton just getting slammed today, down by 3%. When you have to give more concessions to sell your homes, that's not really great. But is that a housing issue, or is that DR Horton, that stock has run a lot issue, which brings us to that margin expectation and the management of expectations, and that brings us to 3M. That stock having the worst day since 2019. We just talked about it, but the idea is, like, why aren't we warning now? And there's already a run into the stock, so you really have to manage that expectation carefully. And Verizon doing really well, adding a lot of subs. Who would have thunk it?
Yeah, actually, a lot of these kind of old school telecoms have actually been doing well over the last few weeks here. That is the search for value. That is the search for dividend. In fact, we talked with PIMCO co-founder Bill Gross. You were here that day, I believe, right?
Like
that was yesterday.
Yeah.
All right. Well, we talked to him and actually got his thoughts not on fixed income, but on the equity markets and where he's seeing value.
Perhaps you should be a little more conservative, but you need to be invested. A 5% Treasury bill, yes, that's attractive, and I have some. But basically, there are certain stocks with higher yields, relatively safe dividends that are more attractive to me than the Magnificent Seven. But tobacco stocks like Altria yield 9.5% to 10%, and the dividend has been raised every year despite the problems with the tobacco industry. There are stocks like Verizon and AT&T that yield 6.5% to 7%, and so you can go to areas where there's perhaps still some growth, like with Verizon and AT&T, and a high yield at the same time. It just seems like a better bet for an investor that wants to conservatively earn perhaps double digits going forward.
And of course, that was Bill Gross on the big program yesterday, right here in the Here and Now. Leo Kelly joining us. He's the CEO over at Verdance Capital Advisors, live with us here in Studio 2. And Leo, I mean, Bill Gross is looking for value. I feel like every investor we talk to these days is looking for, I guess, what they determine to be value.
Right.
Do you find that out there?
Well, I think absolutely. If you think about last year, the S&P 500, great year, but the same 500 stocks equal weighted had about half the return. Mm-hmm. And that was actually saved by the last 6 weeks of the year. So to me, that says the market is overly narrow, and that means there's opportunity.
There's a potential maybe for this broadening out, though someone pointed out to me that a lot of times when we start to see that broadening out, that also tends to signal the end of the bull market run.
Well, I do think as you take a step back and look at what's actually happening, there's a lot of optimism around the Fed, 6 rate cuts. Where that came from, I have no idea. To me, if you take a step back and you think about, okay, asset prices are making all-time highs, inflation is starting to slow down, the consumer has a lot of confidence, and we're going to get dovish, we're going to cut 6 times. We're really just now past neutral. And so, yeah, maybe they bring it a little bit closer to neutral, but these rates are not historically high. They're kind of at the low end of normal.
Yeah, that's
and so I just think people aren't used to this, and that's part of the challenge.
So you bring up an interesting point, because if you have, say, 6, 7, 5 rate cuts sort of priced into the market, but then you have earnings expectations still really strong. So one of those two things can't be true, right? Because either you're going to cut 6 times because the economy stinks, or earnings expectations have to come down. It sounds like you're thinking it's the latter.
Yeah, I still think that we most of the market gain last year was PE expansion.
Okay.
Earnings just started to go positive at the end of the year. I think when we take a step back, this year earnings are not all that exciting coming into the year. So the Fed tends to get what it wants, and the Fed wants to slow things down. I think we have to be really careful here. Inflation can come back. There's still, at the end of the day, M2 grew by 40% over 2 years. That's third world country stuff. Okay, so if we act too quickly on the cuts, money supply is still very, very strong, and the concern is inflation comes roaring back.
Is that your base case? Is that your base case?
Our base case is absolutely, if the Fed gets overly dovish, we have inflation coming back, and it comes back unexpectedly. So I think this is a time, the way we're looking at portfolios is be disciplined. Keep your portfolios exactly where they should be. We're neutral weighted on equity. So we're not running away from equity, but we're also not chasing this thing. Look at valuations. Some of these names have really exploded to the upside. The valuations are very, very high. Be disciplined.
I do want to go a little bit deeper into that sort of risk of a potential reacceleration in inflation. You mentioned money supply. We should also point out this is an election year in the U.S. where typically you will find politicians trying to exert a certain level of pressure onto the economy in order to make things look good here. And I'm wondering if that becomes maybe sort of that inadvertent roadblock here for any sort of additional rally.
Yeah, this year's going to be an unusual election year, more so than any other year, right? We have mixed Congress right now, and the president's numbers are not very, very high. So the bully pulpit may not be as strong as what it has been traditionally. And so I think I don't know that I would look to that. I think this is a case of money supply is starting to slow a little bit. The Fed is starting to slow things down a little bit. Right now they have Goldilocks. Goldilocks is it's very rare.
Yeah.
It's very rare. So I think, again, this is not a case where you should run from the market, but it is a case where you have to be very careful in not letting your allocations get out of line.
So is that the biggest risk that you're looking at right now? The potential for a reacceleration?
Yes, I think I think the Fed not cutting as much as people think.
Yeah.
I still think there's recession risk out there.
Yeah.
Right. The Fed is purposely. Look at the ISM data. The ISM data is showing a little bit of weakness in jobs. It's still pretty slow. Housing still hasn't come back. Commercial property still hasn't been resolved. We're not out of the woods yet. It's just the market movement seems to have people believing that we are.
But you still have a conviction to remain invested in the market, just more selectively?
Yes. To go underweight equity, we would have to see a run-up in valuations across the broader market that says this is a little too high. Let's back off and find a cheaper asset. We're not quite there on the broader markets. Again, those growth stocks, the AI growth stocks are starting to get there. But other than that, no, I think you can own equity, just don't chase.
All right, gonna have to leave it there. Leo, great to see you in person here. Leo Kelly, CEO over at Verdant's Capital Advisors, live here in the studio. Alex, help us count down to the closing bells. And stocks pretty much where they've been now for since we started the show here. A mixed bag here with the S&P and NASDAQ in the green, everything else in the red.
We're waiting for Netflix. That is definitely going to set the tone for tomorrow as well. It had a huge run already, so can it actually beat and then get even more of a run, or are we just going to have to cool down no matter what?
Yeah, no disrespect to the banks and the other things, but I always felt like Netflix was like the true start of the earnings season, at least in this modern era.
You're allowed to say that?
I guess in the
Can
old
you say
days
that?
it was Alcoa and GE.
It used to be Alcoa.
But now, of
That
course,
definitely is gone.
You kind of look to Netflix to set the tone, again, given text. All right, we are moving closer to the closing bell. Our full market coverage right here on Bloomberg, it's coming up as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. And here to help take us beyond the bell, it's a global simulcast. We're joined right now by Scarlett Fu here in Studio 2, Carol Massar and Tim Stenovic in our radio studios. So welcome to all of our audiences across all of our Bloomberg platforms here, Carol, on this Tuesday afternoon. A bit of a breather from that record rally that we saw over the last couple of sessions.
Absolutely. Such a tight range today. It really has been earnings focused. So if you've had a good earnings report, you tend to rally. If you haven't, you go to the downside. I've been looking a lot. We have really, I'm assuming you guys too, about the airline sector. If I look at the S&P Super Composite Airlines Index, it's off its highs, but still up about 3%. All 9 names have been really trending higher for the whole day. So we know they have United Airlines to thank for that, really upbeat in terms of their outlook. So that is really some outperformance in today's session.
Did I see that you guys just spoke to Leo Kelly?
We did.
We did.
Actually.
We spoke to him earlier, too.
Did we warm
I know.
them
We
up
send
for
our
you
guests
nicely?
over to radio. Have you warm them up for us?
Yeah, well, did he tell you that? Did he
He gave us all the good stuff, by the way.
Did he tell you that he thought that the market is ahead of itself when it comes to rate cuts, and he thinks that they're only going to see 1 or 2 rate cuts this year?
He didn't say 1 or 2. Did you say 1 or 2?
He said 1 or 2 to us.
Did you say 1 or 2? Okay.
I mean, that's very much below what the market is expecting, Scarlett.
He's definitely in the camp of inflation reaccelerating and that being an issue for the market, something that we haven't priced in just yet. As much as we say the market's taking a breather, we're still at record highs, guys.
Anytime it's green on the S&P, right?
Yeah. At this point.
That's how it works, but you don't want to sell that to Alex Steele.
No,
She's
I
been
can't get
poo-pooing
excited.
this rally all
I can't get
day
excited,
long.
guys.
What kind of increase gets you excited?
All right. Well, we got a lot going on here. Remember, we're going to get Netflix here after the bell. All 7 of the Magnificent 7 stocks are in the green here on the day. Netflix, a modest bid as well. Netflix earnings right now crossing the wire. Let's get right to it here. In after hours trading, the headline number coming in the fourth quarter, streaming paid net change in subscribers, 13.12 million. Net subscribers added in the fourth quarter. The street was looking for 8.91 million. So that's a huge beat on the streaming side. As far as the actual dollar figures goes, EPS in the fourth quarter, $2.11 a share. The street was looking for $2.19. So a miss on that number. Revenue coming in at $8.83 billion, a slight beat over street estimates of $8.7 billion. Here's your forecast going forward. For the first quarter, the company is projecting EPS of 4.49 and change. The street was looking for, on average, guys, $4.09.
Wow, it's really good. You're looking at the stock kind of pop after hours as also trying to settle out here, but we're up over 5% at this point. What I'm also super interested in, the operating margin came in at 24%. The estimate was for 22.7%. So if you were worried about content spend, maybe you're not as worried about it right at this moment, Carol.
Yeah, and it's interesting. As you said, the stock was popping around a little bit right after the results. Right now, it's up about 6.7%. 7% here. So, Scarlett, we're seeing investors certainly buy into it, and they like what they've heard, at least initially.
All right. We also have earnings coming out from Texas Instruments, the chip maker. And what we can tell you is that fourth quarter revenue, trailing analyst estimates, $4.08 billion. Analysts were looking for $4.13 billion. So this is yet another quarter of revenue declines. When it comes to the first quarter revenue forecast, that too misses analyst estimates, $3.45 billion to $3.75 billion. The consensus was above above $4.09 billion. So this would mark the 6th straight quarter of revenue declines for Texas Instruments when you include that outlook. When it comes to the bottom line, fourth quarter EPS was $1.49 versus $2.13 last year. And fourth quarter CapEx was just shy of what analysts had been anticipating, $1.15 billion. Texas Instruments says it sees increasing weakness across the industrial sector. And that's similar to what it had said last quarter.
It also says sequential decline in automotive, which is kind of interesting.
So that really, I'm looking at the press release right now, increasing weakness across industrial and a sequential decline when it comes to automotive. I mean, that's kind of like what we saw, Romaine, with Mobileye, right? They were talking, Mobileye got hit really hard earlier this year because of a decline in the automotive business. I mean,
yeah, and we kind of saw this coming too when we got some of those auto sales data at the start of the year, the start of January. It was very clear that we're seeing a material slowdown, not just in EV sales, but really in auto sales overall here. This is the bread and butter for a lot of these companies in terms of, at least in terms of profitability. And so if that's waning here, you have to adjust that model pretty significantly to the downside.
Yeah, looking a little bit at that fourth quarter, I'm going to go back to Netflix or stay with Netflix for a moment. Looking at their fourth quarter letter to shareholders, they say there's plenty of room for growth ahead as streaming expands. They just talk about, entertainment, improving Netflix faster than their competition. So they seem pretty upbeat, and it certainly looks like investors feel the same way about Netflix here in the after hours. Stock still up almost 7% or at 7% here.
Yeah, I think it's worth, though, going over for a second. Streaming paid memberships.
It's
over
right?
260 million.
Yeah.
I mean, that is a big, big number. Also, I just want to point out the content spend is actually up about 17. I just had the number and then it went away. 17.
They're moving quick on the
billion.
terminal.
I mean, they're definitely doing it. Like they're definitely spending the money.
Well, hang on. That 17 billion though is actually below where they've been for a while. Remember, they ratcheted that down. Yeah, it's better in terms of obviously from a cost perspective. But I mean, I hate to poo-poo this, but at the same time, like, where's that content going to come from? I mean, we were speaking with Alicia Reese over at Wedbush earlier,
WWE,
and she was she was very bullish on this WWE deal and saying that the cost structure of that, particularly given the ad component that's baked into that, might actually be the new model. You overlay that with the resignation that we learned about yesterday of Scott Stuber, who headed the film division, and maybe that is the future here.
Well, it's also going to come from games. I mean, these are all places where a few years ago you spoke to anyone.
Yeah, that's a new part of the business.
Here's what they said. Here's what they said in the letter. With a better slate, easier discovery, more fandom.
Single guys.
Establishing ourselves in new areas like advertising and games, we believe we have a lot more room to grow. It's a $600 billion opportunity, revenue market across pay TV, film, games, and branded advertising. And today, Netflix accounts for only roughly 5% of that addressable market. I mean, if you were to go back in time and show this to someone 5 years ago and say Netflix would get into sports, Netflix would get into live, Netflix would get into WWE games. Well, it's
live, though. You've got to tune in at a certain time, and it goes after a different audience. Like if you think about the potential,
they did this with golf. They experimented with golf a little bit. They're doing it a little bit with tennis. So they're dabbling in sports a little bit. I mean, this is like never say never when it comes to Netflix, because the Netflix that they're building right now is so different than what they were building just a few years ago.
And remember, that's the thing. They're building their advertising tier, whereas the other streamers, they had advertising and they're trying to transition to streaming without advertising and then trying to add an ad tier on top of that, right? So Netflix is building something out of scratch, and it has only to go up from there.
All right, just to rehash, we've got Netflix up about 4.6% in the after hours. What's really key, too, is if, it seems really upbeat, the stock is rally. We think about all these major stocks, these big names, the FANG stocks that have really been outperforming, right? Do they, measure up to their valuation? So here's one of the first ones, right? And so I think it's just an interesting part of the market conversation about whether or not these that have really provided so much momentum to the market starting late last year, whether or not they can continue. Netflix is showing that maybe, it can.
Yeah. Something else I should just mention here. The company says we're not interested in acquiring linear assets. What does that mean? Paramount?
We don't want ABC's networks? Like, what does that mean?
CBS, ABC?
No idea. But I am curious about this idea. I mean, we're so focused on this blowout on that subscriber number here, but I mean, Netflix was the one that pivoted us away from looking at that number and wanted us to look at the profitability, and the profitability came up short. So I'm a little confused.
So does that mean that the share of subscribers are going to the advertising supported plans, Alex? Does it mean they're not upgrading to the higher, the more expensive multi-stream platforms? What does that mean?
Well, I don't think that there's enough ad sales for that to be a mover. It's such a small portion. Geetha Ranganathan of BI says that, look, if this is a $30 to $40 billion company, at some point you could see 10 to 15% of that come from ad sales for revenue, but we're not there yet, so I don't know if that's a fair comparison yet.
Well, within the statement, the company does say ad plans now account for 40% of all Netflix signups in our ads markets, wherever they have launched the ad tiers. And we're looking to retire our basic plan in some more ads countries. So that gives you a sense, where you can just stream all day long without watching commercials. At some point, that might go away.
What's interesting, too, I'm looking at the headline in our story. Netflix posts best customer gain since the surge during the pandemic. Remember, we came out of the pandemic and we're like, okay, we're out doing things, we're flying, we're going places. And yet this is showing that, they are able to bring back in customers, even though we're doing all these other things.
I also want to know how much of this has to do with them cracking down over the last 6 months or so.
You mean like your
9
brother?
months. Yeah, like my brother, who now has to get his own Netflix account rather than just mooching off the family still.
Yeah,
that's a big part of it.
Yeah, it'll be interesting to see what happens on the conference call, which they moved up a little earlier than what it would normally be. So it'll actually be starting here while we're in the hour, while we're here on Bloomberg Television. So we'll have a breakdown here of anything that Sarandos and the other folks on that have to say.
Yeah, lots of questioning. Netflix still up about 4.3%. We've got Texas Instruments, though, folks, down about 3.6%. So we'll continue to track them into tomorrow's trade. All right, that's a wrap, guys. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you same time tomorrow.
All right, a deeper dive into the numbers, a walk through here, the strategy going forward. Dan Morgan over at Synovus Trust, Mark Douglas over at Mountain, and a whole host of other folks going to be stopping by the big program as we keep an eye on Netflix. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bostick. We're seeing the focus shift from the Fed pivot party to an earnings reality check. It's not in an extreme way, of course, because you have the S&P 500 and the Magnificent 7 index still closing at record highs, but the gains certainly have moderated. You do have longer dated treasuries losing ground, so the 10-year yield moves up by 3 basis points. And I just threw in here for an overseas look, the ETF that tracks big cap Chinese stocks up 4.6%. Bloomberg reporting that Beijing is considering some measures to stabilize the falling stock market. FXI had lost about 18% over the past half year. Now, in terms of the earnings reality check that I had mentioned, 3M, the worst decliner in the Dow and the S&P 500, losing 11%. And this is after its restructuring efforts helped its fourth quarter, but its full year forecast disappointed because of overall macro uncertainty. Johnson & Johnson losing about 1.6% on the day. Margins at its medical device unit declined, and pharma sales will fall in the second half of this year because of competition in Europe. Now, two companies that reported after the bell, Texas Instruments lost ground before its earnings report. And when it did report after the bell, it gave a weak forecast, citing in particular industrial customers such as the automotive sector. And Netflix came out with blowout subscriber additions for the fourth quarter. It gained 1.3% before the close. And of course, it also had that big announcement that it is getting into live sports, if, Romaine, you can call wrestling live sports. I still don't believe that it is. All right, let's stay with Netflix for a moment, because this is a stock that has climbed more than 40% since its last earnings report in October. Even so, it's nowhere close to the record high it set back in late 2021 of $691. In fact, it's got another 40% to go to get to that point. With the launch of its new ad tier, there's a lot of optimism that Netflix will continue to blow out expectations. So much so that, in fact, Jason Bazinet of Citigroup yesterday was telling us that the setup heading into today's earnings report was not particularly favorable. That has not necessarily come to fruition given the numbers that Netflix did give us, but that does set us up for some interesting questions down the road. Romaine?
All right, recapping the numbers here. Netflix, of course, is streaming paid net changes right now, 13.12 million here. That's up 71% year over year and well above street estimates, which were right around 9 million. On the revenue side here, revenue did grow up about 12% year over year to 8.83 billion, though just a smidge above street estimates. Some concerns here on the EPS side, which did miss estimates at $2.11 a share. The street was looking for $2.19. Dan Morgan, Synovus Trust Senior Portfolio Manager, joining us right now to talk a little bit more about what we learned and, more importantly, Dan, about what you expected. Are you pleased with this report?
Yeah, Romaine, I mean, obviously a big beat in terms of the number of subscribers on the fourth quarter, over 13 million. Coming into this quarter, Scarlett and Romaine, we know that Netflix had announced about a week or two ago that they had ad tier subscriber or monthly average users greater than 23 million. So I think that kind of gives us an idea going into this quarter that we might get a pretty good beat. We have to bear in mind about 30% of all the new subscribers are ad-based. It's not a huge portion of the 260 million people that are subscribing, but of the new subscribers that are coming on. So that announcement coming out really edged up the consensus estimate in terms of expectations for number of users on this fourth quarter. I think it was 8.9. You said it was 9 million. It kept moving up. As we got
I was
closer
just
to the
doing
bell.
them a favor and rounding up here. But even when you go down, I mean, through the regions here, we talk about in Europe and Middle East, that was up 58%, Latin America 34%, and even in Asia Pacific region, that was up 62% on a year-over-year basis. And all of those were well above, in some cases, what the street was looking for. Dan, this is now a growth story once again. I felt like a couple of quarters ago, we were basically told that growth is over for this company. They're too big.
Yeah, and like you were talking about, Romaine, I mean, the two key growth areas that obviously is movement toward the ad tier. We know they do basic with ads. I think it's $6.99 a month. It's very inexpensive. And then the paired share or the paid sharing, which you talked about earlier with Tim in terms of password sharing. Those are really the growth drivers going forward. That number, Romaine, that you gave on APAC, Asia Pacific, that was a huge beat in terms of number of subscribers compared to what the street was looking for. So it's interesting to see them get kind of reinvigorated with growth, right? Scarlett and Romaine, after we had that big blip during COVID, then they just really dropped off the roof. And now we're getting growth again, and it's being driven by some different fundamentals than we had in the past.
Yeah, just over the past 6 months, when you combine what happened in the previous quarter, Netflix added about 21 million subscribers. That is kind of unreal when you don't have a pandemic locking people in. What do you think is going on? How come people got it wrong by so much?
Well, again, Scarlett, I think it just goes back to these new content that you were talking about. I mean, you were arguing whether wrestling is a sport or not. They are getting into gaming. They've gotten into a lot of other different things. I mean, they did, 260 million total subscribers, accumulated versus 256. I think that was the estimate. So they just continue to add on, and it's kind of a different model than we've had in the past. It's more cash flow based. Romaine, you were mentioning earlier about their streaming content obligation in terms of it actually kind of dropping down. So costs seem to be coming back a little bit. I think the estimate is roughly around 20 billion. I think you mentioned they did 17 billion. So it's just a different story than it was 5 years ago, and they just threw money at every script that came in, and they produced it and they built it out in all these series. It's becoming a different animal. It's becoming a different animal, and I think it's safe to say that Netflix has won the streaming war. My question is its lead insurmountable, or do we need to add for now to the end of that statement? Well, I read that the average user has 4 streaming channels in their house. I think I have 2 or 3, and everybody has Netflix. So then it's kind of a battle between these other streamers, Paramount Plus, and all the other ones, Apple Prime, so forth, who can kind of get that remaining pie. But, Netflix still kind of leads the pack. And you brought up a good point earlier, Scarlett, when you talked about how a lot of them led with advertising, giving subscriptions, and now they're pulling back and trying to kind of weed that off, where Netflix was always no advertising, and now they've had this different tier. So it's kind of a different approach. It's a different approach, and it seems to be paying off right now, certainly if you look at the stock in after-hours trading. Daniel Morgan of Synovus Trust, thank you so much for giving us your instant analysis on Netflix. All right, let's move on now to the top 3, where we take a deep dive into the people at the center of the day's top stories. And Romaine, the common thread is that they're all in the entertainment industry. We were talking about Netflix. Up first is Dwayne "The Rock" Johnson, because TKO is making deals beyond selling WWE rights to Netflix. It's also paying $30 million in stock to the former wrestler to get his name, image, and likeness rights
Nice. Yeah, this is a big deal. I mean, The Rock now going to be on the board, and of course, everyone's talking about. I mean, you can debate whether it's a sport or not, but it is, of course, one of the most watched live events out there. Certainly beyond that sort of big tier of sort of NFL and Major League Baseball, the big sports. Actually, probably outdoes MLB.
I think so.
But anyway, this is a big story here, and of course, it could end up being the future. And that brings us to the second person we're watching, who is Scott Stuber, who's exiting the company sometime in March. He was basically the film chief at Netflix. They brought him in back in 2017, and any of those big prestige films that you heard about, Bird Box, Glass Onion, all those types of things, that was basically because of him. These got a lot of critical acclaim, but Scarlett, there's a lot of discussion here about the cost to produce those films and whether they actually generated a real financial return. And when you overlay that with the deal with WWE, it does seem like this could potentially be a little bit of a pivot.
Yeah, well, before today, Netflix has had 8 of those pictures, those films nominated for Best Picture in the Oscars. They won exactly 0, but he was working on Maestro, and that was nominated for Best Picture.
That was nominated. Yeah, the Oscar nominations are out.
Yeah, well, speaking of which...
Did you get one?
Speaking of the Oscars, Greta Gerwig, she was snubbed. The Barbie screenplay writer and director was shut out of the Best Director category. And as you would imagine, the internet has gone crazy. I was reading one tweet about how Greta Gerwig and Margot Robbie made a film about the patriarchy that generated $1 billion for Hollywood, and the man in the film gets nominated for a major award. Referring to Ryan Gosling, of course.
Okay. Well, first of all, the internet didn't go crazy. It's always been crazy. I have to say, I'll probably get flamed for saying this. I don't think she got her name. I didn't think the movie was that good.
I thought there's a lot of stuff.
I'm just sorry. I just have to say it. I couldn't get through it.
Really?
Yeah, I know. I can hear everyone in the control room.
Oh, you're in the minority
I'm
here.
surprised they haven't cut my mic off yet. But I mean, look, I started watching that thing. I was like, I don't get it. Maybe it just wasn't for me. Maybe it really was sort of designed more for women and girls or something like that, or maybe just men with more of an open mind. That's not me.
Not the audience for Barbie. All right, well, we'll get Romaine's movie picks later on. We're going to continue talking about earnings because Texas Instruments did come out with the results a few minutes ago, and so we'll speak with Sarah Hsu, University of Tennessee at Knoxville Clinical Associate Professor of Supply Chain Management, to get her take on TXN. This is The Close on Bloomberg. Texas Instruments just reported its results a few moments ago, giving another quarterly revenue forecast that came in kind of lackluster if you look at how the stock is reacting in after-hours trading, indicating that a slump in demand for industrial and automotive electronic components continues to drag on. So for more on the chip sector and what it means for tech overall, let's bring in Sarah Hsu. She is University of Tennessee at Knoxville Clinical Associate Professor of Supply Chain Management. Sarah, good to speak with you. It was a little surprising that Texas Instruments gave a forecast that sounded similar to what it told us last quarter, that these industrial customers, particularly the automotive sector, continue to show weakness. What does that say about the overall demand for Texas Instruments customers?
Yeah, I mean, I think it reflects an overall weakness in, demand for, as you mentioned, industrial and automotive across the board, not just for Texas Instruments, but for many other companies as well. ASML, which is a company that has been in the news for being banned in its exports to China, that company has also suffered because it hasn't been able to, really get the kind of demand that it's been looking for. And so a lot of companies are facing this sort of slump right now. What this means is that we expect that slump to change over time. The semiconductor industry is always cyclical. So when there's a downturn, there's usually an upturn coming after that.
So give us a sense here when we talk about the potential for, I don't know if we are really at that trough here, give us a sense here as to whether that translates into something direct for these companies or whether the geopolitics and some of the import restrictions are actually going to affect any sort of upswing.
I think that there's a lot of upside for for many companies in the semiconductor industry. From my perspective, I see a lot of upside, especially due to demand for chips in artificial intelligence and other technologies that are coming out. But even the more sort of classic chips, the larger chips that are sold by other companies, including Texas Instruments, those companies are also probably going to experience an upswing as well.
So what becomes sort of, I guess, of this whole back and forth that we've been seeing between the U.S. and China, and obviously the U.S. trying to get Europe on board here? We're talking about a new generation of chips that we know one way or another are going to be in demand, depending on the scale here. But, of course, technology that I think for a certain extent both countries would like to sort of keep to themselves.
Yeah, that is really the difficult part, is that there is probably going to be very little sharing. And, the U.S. has already banned exports of sort of its higher level chips. It's even banned, NVIDIA has tried to beat this by coming out with its own chips that were kind of, for lack of a better phrase, dumbed down for China, or, not as sophisticated for China. That was also rejected. They were not allowed to export those to China. And so the two countries are really separate. And, we're seeing now some indications that China is bringing on board a lot of capacity to produce the legacy chips, the older, larger nanometer style chips. And that, these are also being scrutinized for potential, sales to the United States, and potentially pulling down the prices of chips that are sold in the United States.
Sarah, you mentioned how the industries are, China's semiconductor industry, the U.S. semiconductor industry are moving in parallel. What does that mean for companies like TSMC and Samsung that are kind of caught in the middle? Will they have an opportunity to participate in the growth of China's semiconductor industry?
Well, I know that they really want to. Of course, anytime that there's a market that is open, there's a lot of interest in selling into the market. But it is becoming increasingly difficult. We are seeing, I mentioned ASML, which was a few months ago, it was banned from selling its lithography equipment into China, and this recently took effect. And it has made it harder for that company. But because there is so much, upside in artificial intelligence, that I think there's a lot of positive outlook.
All right, Sarah, we're going to have to leave it there. Sarah Shu over at the University of Tennessee. Stick with us. We're going to have a deeper dive into Netflix earnings. Open up the almanac with a closer look at what the streaming service launched 17 years ago. Welcome back as we break down Netflix's earnings. So just a reminder here that every Tuesday, the company publishes top 10 lists of what people have been watching on the streaming service. In the past week, that leaderboard and views included the British murder mystery Fool Me Once, the plane crash thriller Society of the Snow, and the Kevin Hart comedy Lift. It's among a slate of roughly 7,300 movies and TV shows on the streaming service today. But how many titles did the service have when it was launched? The answer? Barely 1,000. Not only a fraction of the 7,300 titles today, but a fraction of what was then more than 73,000 titles in the company's mail-order DVD business. Of course, we know that pivot away from DVDs to streaming was prescient, tapping into changing viewing habits. We spoke with Netflix co-CEO Ted Sarandos 10 years ago about their first foray into films.
I'd say we were not at a short list yet.
No short list yet.
Yeah. But looking, like I said, completely open-minded about the size and scale and scope of what they could be.
Of course, we know the pivot away from DVDs to streaming was prescient, tapping into changing viewing habits. But now, 17 years past that launch, there are a lot of questions out there about when the next pivot comes. And that brings us to our big number of the day. It's 3. Okay, maybe that's more of a little number, but bear with me here. Last year, Netflix began experimenting with live broadcasts. That experiment included just 3 events to test the waters, including a Chris Rock stand-up special, a Pro-Am golf tournament, and of course that Love is Blind debacle in April where the live stream crashed and left the viewers blind as well. But don't worry, Netflix is ready to give it another try. In February, it plans to stream live the Screen Actors Guild Awards. In March, it'll host a tennis match with Rafael Nadal. And starting next year, the rollout will accelerate on the back of a $5 billion 10-year deal to offer WWE pro wrestling matches. That includes Raw, SmackDown, WrestleMania, SummerSlam, and my favorite, the Royal Rumble. And yes, Scarlett, it is real.
Okay, Romaine. Romaine is a believer that wrestling is a live sport. Let's incorporate all of that and bring in the earnings as well from Netflix and speak with Geetha Ranganathan. She is Bloomberg Intelligence U.S. media analyst. Geetha, I thought Romaine did a fantastic job kind of setting up how Netflix, where it started and where it's come to, years later after it first started sending out those little red envelopes. What is more meaningful to the stock in the near term? The fourth quarter subscriber adds, which were much higher than anticipated, or the fact that it's breaking into live sports?
I think a little bit of everything, right? So basically what the whole story, I think, for 2023, from a Netflix perspective, was really kind of getting the subscriber mojo back on track. And they absolutely have blown it out of the park, right? We saw that subscriber ads fell to about 9 million in 2022. It was roughly about 25, 26 million per year before that. And then now you have 2023, which is an absolute blowout with, 30 million ads. So yes, definitely the subscriber story is very, very important. But along with that, Netflix itself has kind of pivoted to, away from just focusing on subscriber growth. They're also talking about, a lot of operating discipline in terms of revenue reacceleration, in terms of cost discipline, and of course the big number, which is the operating margin, which was kind of the real standout to me. So they not only over-delivered in terms of 2023 numbers, they came out at 21%, but now they're guiding to 24% for 2024, which is a little bit ahead of their prior range. So really everything seems to be working well for Netflix right now.
Yeah, this is because when we first talked about that pivot where they said, okay, they're going to focus on profitability, don't pay attention to the growth numbers, everyone said, okay, that must mean that the growth story is over given the company's size and scale. And now we have a situation where, at least for right now, they seem to have costs somewhat under control. Now they, at least for one quarter, they seem to have a resurgence in growth. So how do they take advantage of this opportunity, Geetha, and not squander it?
So they're going to take advantage by doing exactly what they did this morning, which was that deal with, TKO. They need to make sure that they are scaling their advertising business. And in order for them to do that, they have to invest. They have to invest in content, have different types of content, have content that plays well to advertising, which is exactly, raw and, live sports and other types of sports content. And then they need to make sure that their ad infrastructure is better. And that is something that they've been working on. And also, again, invest in different types of content. I know a few minutes ago you were speaking about them investing in gaming, going into different kinds of, genres of programming, not just focusing on series and film. And that's exactly what they're going to experiment, what they're going to do.
And as they experiment, because they're breaking into new divisions, new businesses, I guess the expectations aren't really set. It's different than the streaming companies that had to shift to from cable-based businesses to streaming, right?
Oh, absolutely. And that's the great thing about Netflix, right? They are constantly rejiggering their strategy. I mean, this was the company that was so resistant to getting into advertising. They were so resistant to getting into kind of live sports. And now they've kind of embraced it because that's where kind of the future is for them. And so I think we'll see them do more and more of that as well, kind of as they kind of build out all of their ambitions here.
All right, Geetha Ranganathan over at Bloomberg Intelligence helping to break down the earnings that we got out of Netflix. Of course, a big focus right now on that strategy, that push into the ad space, a push that at least right now appears to actually have been pretty smart. Mark Douglas is the CEO of the advertising software company Mountain, and we've spoken to him a few times here about Netflix's push into that space here. Based on what we've learned so far, and I guess what is still a relatively nascent business for them, are you pleased?
I think they have a good start. I think they have a long way to go. The move in the live sports is actually a big deal. There's more demand in the advertising world, in the TV world, for live sports than any other form of content. So, WWE is not just going to do well in the arenas. They're going to do, power Netflix doing well on the advertising side. Mm-hmm. But I think that the Netflix is going to have to grow beyond the big brand advertisers long term. Yeah. And that's something they haven't even started yet.
Well, I'm curious, and this might be a little bit of speculation on your part. I know we have to wait to 2025 to actually get these broadcasts or streams, whatever you want to call them here. But how do you think the advertising is going to be structured in that type of formats? Particularly, I know they're saying that some of this will be through the regular, streaming tiers, and others might be actually pay-per-view here. Are those ads going to be traditional commercials, or are they going to be baked in to the programming in some way?
There's a little bit of both, but the thing is that what you're referring to as kind of the traditional commercial, they're easy to sell. You can't go out to advertisers and create super custom formats and be able to sell that at scale. So when you have something like WWE where they have content every single week, there's a limit to how much you can do, like kind of the Super Bowl type promotions, the special promotional event. So ultimately, it's going to be how many people are watching 30-second ad formats that they can, essentially scale their advertising business around with that and their other content.
So in the end, whatever advertising they will have accompany live wrestling or any other sports that they may decide to acquire sports rights in the future, it'll end up looking like cable broadcasts or network broadcasts of sports. Is that right?
Yeah, that is right. And if you look at Amazon, but the difference is, so if you look at Amazon, I think they released some numbers late in the year or early this year. They're doing a much better job of monetizing like Thursday Night Football than their predecessor was. And I think there's an opportunity for to do the same. The way Amazon is doing it is they're bringing their performance advertisers off the Amazon.com advertising business, their search business, and they're bringing them into TV. And so there's an opportunity there. Netflix doesn't have those performance advertisers, but that's why I say they're just starting. If they get this all right, then they can reach out to a whole new group of buyers. And Amazon, to my knowledge, this is the numbers I've heard, but every $1 their predecessor is making on ads, Amazon is making $2. They have doubled the size of that business virtually overnight. And that's where Netflix has the freedom to kind of like build a much better monetization model. They're just not there yet.
Right. And, I just want to contrast Netflix versus Amazon for a little bit here when it comes to their advertising tiers, because Netflix brought out the advertising tier afterwards and is hoping some of the people who subscribe to the regular service maybe switch to the ad tier. It's a new business overall. Whereas for Amazon Prime, they're moving everyone to an ad-supported tier, and if you want to get out of that, then you have to pay a premium. How does that stack things up for Amazon going forward when it comes to the advertising potential on its streaming platform?
Yeah, it literally shows how confident they are in their ability to scale it. And it's exactly what I'm saying. They have, I think it's now a $30 billion search advertising business on Amazon.com, and it's showing they have a ton of confidence in their ability to bring those advertisers over to Amazon Prime. And, so I like to think of it as that Netflix, I think, will have a good year in advertising. Amazon's going to have a great year. They're just much further along in building that business.
When it comes to this idea, also, I am curious, Mark, about this idea that Netflix is kind of coming into this, I guess, fresh and green to a certain extent with regards to their experiment with advertising. But of course, we know that for a lot of us, they are pretty much the dominant streaming service. They're the one that most of us go to first before we go to the other ones here. Is there a sense here, particularly under the stewardship of Sarandos and I guess for that matter, Hastings, that they can sort of really, I guess, claim the lead at some point in this space?
Yeah, I think when you're an investor in Netflix, you essentially almost have invested in two companies. You invest in the streaming company, and they are capable of building an advertising size business that's equal in size to the existing streaming business, and doing that over long period of time, 5 to 10 years. And so, if you're in that stock for the long term, I mean, it bodes really well. I would have Netflix as an investor. I would be treating that as if they just went public, because that's kind of where you're at with their ad business.
All right, you mentioned the Super Bowl earlier. I mean, if there's any one thing that still works on broadcast television, it's the Super Bowl. How long is that going to last for before, I don't know, eventually maybe even the Super Bowl moves to streaming?
Well, I think the Super Bowl is such a unique event that honestly, I don't see that moving anytime soon. It gets the highest rates in television advertising. And certainly you can chop that up. There's local ads. There'll be some streaming, especially maybe outside the US. But I think the Super Bowl is kind of the last domino to fall, so to say, and move from what I think of as traditional advertising to streaming. So it's going to be stable for a while.
All right, Mark Douglas, really appreciate your joining us. Mark Douglas is president and CEO of Mountain. Thank you so much. Soon, before you know it, all the most highly rated shows, and we already know this based on the last couple of years, is just solely going to be NFL games and the Super Bowl. Nothing else will even come close. What happens the rest of the year?
Yeah, I mean, well, there's other stuff out there, and I think I actually like Netflix's strategy to a certain extent. I mean, Amazon sort of went for, I guess, sort of what everyone watches, right? Everyone watches NFL, but you take something like WWE, which is very popular still. The tennis match that they're setting up between Nadal and I forgot who's
doesn't even matter. It's just Nadal.
But the golf tournament they did, so they're kind of going, I guess, somewhat not to, it's kind of nichier, if you will, here, and I think that could actually be to their benefit, right? I mean, there's a lot of appetite for that, and I thought somebody do a good comparison when last year when they did the golf tournament, the Pro-Am golf tournament, and a lot of people made comparisons to the early days of ESPN. Remember early days, they would have the most wackiest sports on, it was like bodybuilding and strongman and stuff because that was all they could afford at the time.
Yeah.
But it actually drew a certain audience there because you couldn't find that anywhere else.
And they did it with a certain amount of irreverence and the narratives, the storylines.
They didn't take themselves too seriously.
No, they didn't, and they had programming that went along with it, which is what Netflix is going to do too.
I just want to go back to his comment too. I thought that was interesting, the idea that if you split this company in two and you look at this new ad business, the idea that should trade like a new publicly traded company here, that's a pretty bold statement here. And I know he's been pretty bullish on Netflix's prospects in the ad space here. Interesting to see how this plays out.
Yeah, we'll see if maybe investors push for something like that one day. All right, let's just get you a recap of how markets closed on the day, because I know Alex isn't convinced of this rally, but it's been a slow melt up, and we're seeing record highs for the S&P and the NASDAQ 100 yet again, even as the bond market finished in the other direction. We're keeping an eye, of course, on shares of Netflix and Texas Instruments in the after-hours trade. Netflix coming out with blowout numbers for the fourth quarter, particularly when it comes to the subscriber growth, and Texas Instruments giving some cautious comments when it comes to its industrial customers. Look for a decline in Texas Instruments tomorrow. This is The Close on Bloomberg. All right, let's shift to politics because the Republican primary is underway in New Hampshire and voters appear to be leaning towards Donald Trump. For more, let's bring in Bloomberg's Kelly Lyons on the ground in New Hampshire. Kelly, when will we start to get some of the numbers?
Well, polls, all of them across the state have to be closed by 8 p.m. this evening. It's going to be a question of how quickly this could be called. Remembering in the First in the Nation caucus in Iowa just last week, the Associated Press and other networks called the race for Donald Trump about half an hour into the caucuses, even starting at around 7:30 p.m. I've heard talk of potentially an 8:01 call here in New Hampshire, but this is really going to depend on how close the race is between Trump and Haley. And the latest polling suggests it might not actually be all that close. Suffolk University and the Boston Globe have been running a daily tracking poll. The last one was today, and Trump is ahead by 22 points with 60% support compared to Nikki Haley's 38. That's a very tough gap to close, and if she wants to do so, Nikki Haley is going to have to hope that turnout is really significant here in New Hampshire. The Secretary of State has forecast a record 322,000 voters showing up to the polls today, but we'll have to see whether that A, happens, and B, if it breaks for Haley or does not.
I am curious here about what we can extrapolate, assuming that Trump does go on to victory here, and more importantly, assuming that Haley loses, because this is really more about her than I think it is about the former president. This is a relatively moderate state when we talk about it. It kind of swings both ways. They sort of value their independence. If a centrist candidate like her can't even narrow the gap beyond 20 percentage points with Donald Trump here, what hope is she going to have in the other states out there?
That is such an important question, Romaine, because yes, New Hampshire does have this really unique base of undeclared independent voters. It's about 40% of the electorate here. So if she can't pull it off here, in what state can she? Her campaign sent out a memo today basically saying, everyone calm down. We're staying in this race. We'll see you in South Carolina. And keep in mind that come Super Tuesday, 11 of the 16 states and territories that will be voting on that day have open primaries, meaning, Democrats who might want to support Nikki Haley potentially could show up. But I asked Frank Lutz Musk if he bought that argument. He's a famous pollster now, runs FIL Inc., and he said the thing is that was true in New Hampshire too. And if she can't get it done here, how is she going to get it done anywhere else? And of course, before we even can get to Super Tuesday, she's going to have to withstand her home state, South Carolina. That primary is on February 24th. She's currently polling something like 30 points behind Trump in her home state. And I've talked with strategists here in New Hampshire who have suggested to me she may not want to be embarrassed like that at home, which raises the question if she cannot pull off a victory or a very, very close second in New Hampshire, if she's going to want to stay in the race for the long haul. That is what she's messaging now, but we'll have to wait and see.
Haley raised about $1.5 million in the 2 days since Ron DeSantis left the race. What indications have her donors given or look to be giving about their willingness to continue funding her campaign through South Carolina into Super Tuesday?
Well, the super PACs supporting her have said they already have resources in South Carolina, that they are going to continue to do that for as long as she is in the race. I spoke with a spokeswoman for AFP Americans for Prosperity Action, the Koch-back group that is backing Nikki Haley. And they said, look, we're already on the ground and we will be on the ground so long as Nikki Haley is as well. Something else to consider here is that Nikki Haley's campaign manager spoke to Bloomberg at a roundtable here at our hub in Manchester just a few days ago, talking about a $4 million ad buy they were making in South Carolina. That's a pretty big investment, does suggest that they have resources and they're willing to expend them in her home state. But again, the result today will likely factor into all of these calculations and frankly how much money she is able to raise going forward, depending on her performance here.
All right, the primary, I should say, now taking place in the state of New Hampshire. Right now, as Kaylee Lyons pointed out here, the former President Donald Trump leading Nikki Haley by more than 20 percentage points. You can check out Kaylee and the rest of her team over at Balance of Power. That's coming up at the top of their hour, and they're going to have special coverage of the results of that New Hampshire primary right here on Bloomberg starting at 8 p.m. New Hampshire time. All right, still ahead, we're going to set you up for what investors will be having their eye on tomorrow, and I'm told it involves more earnings. This is Bloomberg. Welcome back to The Close. The big story of today was obviously those earnings out of Netflix. The big story tomorrow after the bell are going to be the earnings out of Tesla. To help us walk through what we can expect, we're joined now by Ed Ludlow, the co-host of Bloomberg Technology. And Ed, let's get right to it. We know the top and bottom line numbers are usually a lot less consequential than some of the lofty projections that Sir Elon Musk makes. What is going to be the most important thing that you're going to be keeping an eye on?
Yeah, I think it's the basics around the growth story for Tesla. That remember, we judge Tesla from a production perspective on a 50% annual average growth rate compounded on a compounded basis back to 2020. So Tesla delivered 1.8 million vehicles last year, a record. And on a compounded average annual growth rate of 50%, they should say that they're going to build 2.5 million in 2024. But it's never as simple as that. The guidance that they do give is always so carefully worded. So when you get that shareholder deck or PDF hit your inbox, look for those words and see what they're giving us in terms of this year. And then we'll start asking questions about demand of what they're able to build. Absolutely. And everyone will be scrutinizing the release, that PDF, for any insight into demand, given what we've seen so far this year. The stock is down about 16%. I got to ask you about Cybertruck. How much detail are we going to get on that? Because as Romain mentioned, Elon Musk, he's fond of that lofty talk. Yeah, I think Elon Musk threw the detail under the Cybertruck, because when they announced fourth quarter deliveries, they put those numbers contained within the other segment, which includes SX and also the semi-truck. So we don't have anything granular to understand how that's going. We hope for forward-looking data on it. Yeah. Remember that new line plus the discounting they did in the fourth quarter is going to impact EPS as well. Yeah. And even though Tesla's a constituent of the Magnificent Seven, it's pretty much the only one where EPS is due to shrink about 38% year on year.
Ed Ludlow, co-host of Bloomberg Technology. Tesla earnings on watch for tomorrow as one of the big catalysts for investors. Some other catalysts also in the earnings space with earnings out of IBM, CSX, and ServiceNow.
And of course, we'll be breaking down the ones that come out after the bell for you. There's also a rate decision.
Yeah, really?
North America, yeah.
In North America?
In North America.
Canada?
Canada is coming out 9:45 a.m. No change expected. 5% will be the benchmark rate, likely.
The market tanks, blame Canada. All right, we're also going to get some economic data. The S&P Global manufacturing services and manufacturing PMIs are supposed to come out. And this has been the real story here, right? Strength in services, weakness in manufacturing. I guess, thank God, we're still a services economy.
That's right. Services and composite will be above 50, which means expansion. Manufacturing will be in contraction mode, below 50.
All right, so a lot to cover here. You're going to join Scarlett and I, as well as Alex Steele, tomorrow. We'll have a full breakdown of all the market action as we count you down to the close. We take you to the bell and beyond, and of course, those big earnings after the bell tomorrow. Tesla, the marquee event. Stick around today. Balance of Power coming up after the break. This is Bloomberg.